Hello, everyone. Thank you, all the attendees, for joining us today. I hope all the attendees had a great time networking. I am Minakshi, welcoming you all on behalf of Solar Quarter and the First View Group to our webinar on raising finance for solar projects in Middle East, powered by Huawei. I would like to take this moment to throw some light on what we aim to focus on in today's webinar. The renewable energy market is buzzing given the rise of global warming, climate change, and rising sea levels. The Middle East renewable energy market had installed projects worth a capacity of 24,073 megawatt in 2020 and is anticipated to reach 59,656 megawatt by 2027 at a CAGR of around 13.43% during the forecast of 2022 to 2027. This webinar will focus on the renewable energy potential, key investment areas in the sector, understanding the Middle East renewable energy market outlook, and various commercial aspects of funding solar energy projects in the pipeline. Now, I'd like to invite Mr. Simon Villoso, Senior Product Manager, Huawei, to give his presentation.
Thank you. Just a second. Let me know when you see my screen. I think it should be visible right now. Thank you. So I wanted to talk about renewable opportunities. I know the common topic is risk assessment, but I like to see the bright side of the street. So you can correct me later. But let's talk about what are the challenges and opportunities the market, and from the technical point of view also. This is mainly focused on the technical side. And to give a little context, over the 140 years ago, we decided to build the electric grid based on AC, and we perfected it. In the 1970s, the fossil fuel shortages set the precedent for new alternative energy sources, and in the 1980s, the first wind-based power plants started to appear. This was driven by state and federal incentives, for example, tax credit policies or tax transmission fee exemptions. The levelized cost dropped to $0.38 per kilowatt in the United States. And as per usual, after the first steps are taken from the public sector, the private sector is needed to actually democratize it. For instance, space exploration, nuclear fusion, and photovoltaics, as we're seeing right now. More than developed new technologies, we made them affordable. We passed from fixed speed to the double fed and full converter wind generators. And we've also created machines to work in a wider range of wind speed, graded swept area, and working onshore and offshore. Later, solar panels became cheaper, and PV plants or photovoltaic plants were faster to build. We use similar full converters we were using in the wind turbines, but with any source of DC, it could work with batteries, hydrogen cells, whatever. New requirements showed up: reactive power, voltage right-through features, permanent voltage requirements, a limit to harmonics, and energy quality. And it's fair to say all these advances were being imposed as requirements to have the projects approved from the authorities. But as that might be true, there's also a permanent need to increase the reliability of the components. Although the specific of these requirements depend on each country, it's a healthy rule of thumb to stay always a step ahead of them. A successful project is one that meets its expectations, whether it's measured in served energy, few outages, or low maintenance cost. On top of all the electronics I've talked about, we have to add the HVDC project, which uses, like in the case I'm sharing with you, different older technology, such as thyristor. This year, this example from my country, the Chilean operator determined that when the HVDC line is connected in about around 2027, it will find a short circuit ratio less than 1.5. And not to confuse it a lot, but in a nutshell, think of SCR as an indicator of how strong the grid is at the point of connection, or how close you are to a conventional generator such as hydro, coal-based, or nuclear. According to the reliability guideline from the NERC in 2017, an SCR less than 1.5 is considered to be a very weak point of connection. So in order to overcome this issue, the Chilean operator figured not less than 6 GVAs, around 60% of the country peak load, will solve the problem. So in this chart, you can see some simulations we ran in 2020, back in 2020, and we found 2 points that in the two terminals of the HVDC that we had an SCR of 12.5 on the inverter side, and the simulation ran as smoothly as we could find. But when we did the same exercise and at the other side of the line, we started to see some deviations from the stable operation. And those simulations are usually the ones that end up in blackouts or force tripping units. And the question that everybody does is, how long will I be off not delivering power, and how many times this is going to happen over the years? Because this is actually what makes the company owner lose money. This is more propense to lose synchronism. Nobody actually knows how many times this is going to happen, but we have to reduce this risk to a minimum. We need to consider this phenomena for the forecast of our timelines, and also to employ technology that supports these conditions. In a more delicate scenario in China, in Shanghai, we found that today 61% of renewable penetration in the southwest region. We found that a weakly meshed plus an HVDC, a huge HVDC link next to other smaller HVDCs, produced the following phenomena. The Chinese government is trying to increase the solar capacity in this region by building a lot of these huge HVDC links. But the weird thing is that when the short circuit decreases because of the new solar generation, the capacity for transmitting power through the HVDC link, it reduces, and it produces this negative correlation. So for example, if we want to increase from 22.9 gigawatts to 3.8 gigawatts in the same area, the transmission capacity reduces from 2.0 to 1.4. And solutions to this are to adapt the current technologies, such as the grid-friendly features our products have, or to place inverters that act as conventional generators, also called grid forming. But nevertheless, the point to be clear about is that future grids, decarbonized and full of solar and renewable power, will produce weaker grids which are already weak than they were 20, 40 years ago when we perfected the AC system. So to conclude, from my point of view, the technical challenges are the usual. We all know we are far from consumers. This requires consistently more space than conventional generation. They're placed in weaker power grids, and they make them weaker. If we wanna depend or rely on these renewables instead of coal-based, we need to oversize in the periods where the energy source is available. According to my experience, the most difficult part in the building of these projects is the planning, the scheduling of permits and studies, because they should be made regarding the dates when you energize the first time or enter in commercial operation. This was a very critical point here. It still is in Chile when it's you're about to connect to the grid. And from the political point of view, I think the greater challenges are the public opinion, especially when you're speaking about huge transmission line that cross several communities. In the case of the Chilean project is 1,500 kilometers, so it's a huge project, and we need the collaboration from everyone. That includes also the environmental permits, and for that to be understandable from the beginning, the projects must be developed with proficiency. If you wanted to communicate the benefits or the challenges or the disadvantages, even, you need to be clear about that from the beginning. So you're always going to have people against your project, but with this kind of focus, you can reduce that to a minimum. Um, that's what I had prepared for today. I hope it wasn't too technical. They told me not to be too technical, but I couldn't resist sometime, and apologize for that. I appreciate any questions. Thank you.
Thank you for the insightful presentation, Mr. Simon. Now, without further delay, I would like to introduce our panelists for this webinar. Mr. Sameer Zavayade, he is the moderator for the session. Mr. Ali Tahir Jafri, Executive Director, Standard Chartered Bank. Mr. Manpuran Chaudhry, Director, Project Finance, Europe and KSA Alfanar. Ms. Denisa Finis, Secretary General, Middle East Solar Industry Association. Mr. Johnny Collin, Founder, Wari Consultancy. And Mr. Simon Veloso, Senior Product Manager, Huawei. Before handing over the session to Samir sir, I would like to take this moment to remind all our attendees to post their questions in the Q&A chat box, and our panelists will take it up at the end of the session. Now requesting Mr. Samir to lead the discussion.
Thank you very much, Meenakshi, for this wonderful introduction. A big thanks to Solar Carter for their continuous support of the solar industry. And then a big thanks to Huawei for being the sponsor of this event. We start our event with Mr. Tahir Jeffrey, Mr. Ali. Mr. Ali is the Executive Director at Standard Chartered Bank. It's one of the most experienced infrastructure professionals in the Middle East and North Africa region. Mr. Ali joined the bank in 2003 with the client coverage team and moved to the bank's project finance team in 2005. He has since been instrumental in structuring and closing a number of landmark transactions in the infrastructure space, both as an advisor and as a debt arranger across multiple industries. Prior to joining Standard Chartered, he spent over 4 years with KPMG in the assurance and consulting areas. Mr. Ali is a chartered accountant by qualification and holds a bachelor degree in commerce. Welcome to our panel, Mr. Ali. It's a pleasure to have you with us. Can you
Thank
hear
you,
me
Mr.
well?
Summer. I can hear you.
Yes.
Thank you, Mr. Summer. It's a pleasure indeed to be with you in this panel.
Excellent. We'd like to start by asking you a few questions. The first question is, what makes a project financeable, and what can the resource-rich nations in the region do to create a vibrant, clean electricity financing markets for renewables? Over to you, Mr. Ali.
No, thanks, Mr. Summer. It's obviously the fundamental question is that what makes a project financeable? Look, I mean, from a bank's perspective or any project finance investor's perspective, I think the key thing to look for in any project, not in only in a renewable project, but any infrastructure project or anything, is that whether that project is required or not. Because we have seen in the past projects being put up, capacity being brought online just for the sake of it. So the first thing to for us to assess is that whether the project where the project is being placed, whether the project is required in that particular geography or that particular place or not. And that is question number 101. And once we assess that the project is actually required for whatever reason, I mean, whether it's replacement of old capacity or commitments to net zero or just expansion of the network, once we assess that the project is instrumental, then what we feel is that things do come together. Once we assess the viability of the project, then things do come together, and between the regulatory parties, between the sponsors, the developers, the contractors, and the lenders, they do generally make the project happen. So where we see the projects getting delayed, I mean, I think it's primarily because there is the urgency of the situation is not so much. But in this region, what we've seen is that the renewable capacity over the last 7 years. I think 2015 is when Dubai announced its second phase of which was essentially the first PV project in GCC. What we saw in 2015. Since that time, we've seen is that everybody is working together to make the dream happen, and it has been kind of an explosion of renewable projects across the region, from Saudi to UAE to Oman to Jordan, Egypt. We've seen so many new projects, and sometimes, and to your question, to your second question, that what do the resource-rich countries, and sometimes people do ask this question that these countries, especially the Gulf countries that have the hydrocarbons, they have the resources. Why are they so keen on putting up the renewable capacity? And the answer is quite simple. I mean, what people do ignore is that these countries are quite rich in the other two resources as well. One is obviously abundant and predictable sunlight, and then there is a lot of land which can otherwise not be used for agriculture. So they have abundant resources for that as well, and it only makes sense to uh, to put up solar projects in these countries. Use that land, use the sunlight that you have, use the indigenous resources, and you can always put the hydrocarbons up for sale to countries that need the hydrocarbons, right? I mean, whereas they continue to diversify in the solar space. And it's not only what has happened since 2015. If you look at the plans as well, all the countries have set up very, very ambitious targets, especially Saudi, very, very ambitious targets of putting up new renewables capacity. And we've seen multiple projects coming line every year. We have seen both Repto and PIF pursuing solar projects. And as they say, you got to make hay when the sun is shining, and that's what these countries are doing. And I have a very strong feeling that this is only going to multiply as the effects of the pandemic, which has constrained the supply chain to an extent, as they wear off. You will see an increased focus on new investments in the solar and renewable space. Thank you.
Thank you very much, Mr. Ali, for the insightful answer. My second question is what are the financial risks of investing in renewable energy portfolios? And how safe is the clean energy sector as an asset class? Over to you.
Yeah, look, I mean, I guess I'll just start off where I finished the answer to the first question. So I guess the key risk right now, whichever developer is looking to invest in solar, the key risk in the region remains the supply chain. And there's a there has been over the last couple of years quite a lot of stress on on the entire supply chain, but especially anything that is originating out of China because of the COVID-related lockdowns, which coupled with when you incorporate the inflation, the panel prices, the module prices have gone up. Obviously, we've I think a couple of years ago we bottomed out at on the tariffs. We went down to tariffs very close to 1 cents in solar PV space. They've started to move up again. So it is very important for the developers and the lenders to price everything very correctly. I mean, you do not want to underprice in the search of the lowest tariff. I think you do not want to underplay or downplay the situation in the supply chain market. I mean, it's still recovering from the effects of the lockdowns. I mean, things are coming back, but they're still not what they used to be like 3 years ago. So everything needs to be priced correctly and modeled correctly. Debt pricing needs to be taken into account as well. I mean, while there remains to be a lot of liquidity available in the market, especially for investment grade countries like Saudi Arabia, Abu Dhabi, uh, um, the base rates, as you know, are rising. The forward curve has gone up sharply over the last year or so because of the concerns on inflation. The interest rates, base rates are going to continue to go up. So, in while there was this real battle for the lowest tariff in the region over the past 3 years, I think that needs to be looked at a little more carefully now because things are not what they used to be. So I think that is the biggest risk, that you don't want to underprice a development while investing. You need to be very careful at pricing everything appropriately. EPC is the same. EPC is is because there is so much of coming online, the competition in terms of getting the projects from a developer's perspective is still there. However, the resources from an EPC perspective and from a supply chain perspective, there is just too much of demand that is going to come online over the next few years. So people need to be careful. Developers need to be careful. Lenders need to be careful as to which projects to go in for. Um, as far as the good thing about the region, however, is that the regulatory policy is very clear. They're very, very clear objectives that have been laid out by the governments. Uh, the government is offering long-term PPAs. All the governments, they are standing behind the solar space. They continue to invest. So from a regulatory perspective, the risks are minimal. From an investment perspective, everything needs to be assessed very, very carefully. The other couple of aspects that people need to sort of just look at is because in the quest for obtaining longer term financing, because we have seen financings going all the way up to high 20 years, like closer to 30 years. People sort of sign up to structures which have cash sweeps, etc., embedded in the structures, and which effectively, from a sponsor's perspective, an investor's perspective, requires the sponsors to refinance at some point of time. Now, if the interest rate environments continue to go up, that interest rate risk obviously lies with the sponsors. And if the market liquidity kind of at some point of time, as of tightening, monetary tightening or whatever, then refinancings will become a bit difficult. So
Yeah, it
sponsors
seems
need
that
to be a bit
we
careful
are having, yeah.
about embedding we have already seen fixed income has
Okay. Mr. Ali, we can't hear you. Maybe there is a problem with the connection. I will shift to another speaker, and we'll come back to you. Hopefully, the line will be much better. Is that okay?
I'm not sure, Mr. Samir, I'm not sure if you're able
Yeah, the line is.
to hear me, but
Yeah, we can hear you now, but it froze. Yeah, can you repeat the last few
I mean, I
sentences?
think
Go ahead, Ali. Okay. Okay. Let's move on to Mr. Manpuran. Mr. Manpuran, are you with us?
Yes, yes, Mr. Samar, I'm there.
Ex-
Yeah.
Excellent, excellent. Mr. Marponan is a project finance. He's been in the project finance profession for the past 16, 17 years, and he has experience in raising financing for various renewable energy projects and infrastructure projects. He worked across the Middle East, Europe, and India. He's currently working with Alfanar, which is a very big group, as the director of project finance for the past 5.5 years. He has experience in raising equity capital, project financing needs, and a lot more activities. Mr. Manpuran, can you tell us from your experience what makes a project financeable, and what can the resource-rich countries in the region do to create a vibrant, clean electricity sector, financing markets for renewables? Over to you, Mr. Manpuran.
Thank you, Mr. Samir. So let me speak from my experience. What are the things project finance needs? Basically, I'll talk about the corporate, and then I'll go to the lender side. What are the things they will be looking at to finance a project? So the first thing I would like to highlight the project itself. As Mr. Ali said, the project has to be there. The project has to be needed by a country, by a jurisdiction, by a location. So the first thing first, the project has to be there. The project has to be viable. I mean, the project feasibility has to be studied properly before launching a project in any area or any country. So the first thing first is the project, whether the project is needed or not. Then you have, obviously, for solar projects, it is radiation. Basically, we call it irradiation, and for wind it is the wind speed and so on, whether the wind resources are there, the solar resources are there to set up a project. Like Egypt, KSA, and entire Middle East regions full of irradiations. The irradiation is really good, uh, with efficiency of more than 25% sometimes. And the location, obviously, they have plenty of lands, they have plenty of deserted land which can be used for the project financing. So these are the few aspects of the project feasibility. Then we'll come to the financial viability. So the financial viability obviously would be considered when you are talking to your banks or a investor to finance the project. So for financing the project, the obviously the cash flow has to be guaranteed. So for the cash flow has to be guaranteed, there should be a long-term PPA. A long-term PPA with a good counterparty, that's a government body, would make the project financeable. So that is on the project cash flow. And then yes, whether you have sufficient security on the payment mechanism, whether you have a termination right, whether there is a termination right from the government side for this particular project who is signing the PPA. So if there is a termination right, then there should be sufficient mechanism for you to uh, secure the asset from the lending perspective or from the investor perspective. So these are the two main areas. One, as I said, the project feasibility, then the financial viability. You have to have a good opting arrangements or long-term opting arrangements with a government body or with a private body with a bankable counterparty. And the fourth aspect of making a project financeable is obviously the banking sector. Whether there is sufficient liquidity in the banking sector, the country if you are asking for financing from a different lender, from different countries, then whether the country is really bankable, the country has a good rating. Like for Saudi Arabia, it has a good rating. It can raise finance from various other jurisdictions as well. In case the country risk is more, if it is not investment grade like Egypt, then we need to talk about the presence of credit agencies or the insurance agencies like MIGA or ECA. These kind of arrangements can be managed to make the project financeable. So this is about the project financial project, whether a project or what makes a project financeable. I'm talking about solar only. And then what should government do? The first thing first, the government should do to develop a merchant market, because right now all the projects in Middle East are mainly relying on the uptake from the government entities. Mostly the counterparties of the PPAs are government entities. Now, whether we can develop a merchant market where the developer can sell the electricity on the merchant market to get a higher price for their produce. So that is one. Second thing is there are a lot many competition in the market right nowadays. If you, as Mr. Zari said, the tariff has gone down to 1 cent. Whether this 1 cent is viable over a long term because of the supply constraint, because of the interest rate goes on the other side. No, the competition has to be limited. The government has to push for a minimum tariff for the electricity. So this is the second point. The third point I would like to highlight, it is not applicable to most of the Middle East countries, but in other jurisdictions, what I have seen is getting a permit, getting the land for a project of solar or wind is really difficult. It is not so fast a process. So we have to make this process faster, because when a capital is involved, it has a cost of capital as well. So if the process is faster, it is easier to make the project more viable. And then if a country is not A rated, or let's say triple B plus rated, then obviously they should arrange something with different insurance agencies to extend those supports. So this is about the project financing question. Now the next question is, you are saying how safe is the clean energy as an asset class? So for me, uh, clean energy compared to other energy sources makes huge sense. First thing is, for a clean energy, the risk of construction, the operations is limited, because nowadays the solar has become a commodity, and people can make construction of solar plants irrespective whether they are a huge expertise in that country or not, because nowadays the supply is very matured, the construction is very mature, the industry has become a mature industry. So the construction, there is sufficient manpower for the construction, sufficient manpower for the operations. So the construction and operations risk is limited now for the clean energy sector. On the other hand, we are getting long term PPAs for this clean energy. Various governments are signing 25 years PPA, 30 years PPAs with developers. So it makes much safer compared to other asset class. Then obviously the third point would be, is that the stable generation of energy. We have stable generation. We'll find stable generation from the energy sector. That is, whether it's wind or solar, you will get kind of a stable source of energy throughout the year. Uh, for solar, I would like to mention about the operating cost, which is much lower compared to other energy sector, whether it is gas or coal-based plant. The cost of operations is really low. It is only 10% of the revenue you are making. So this is how I would like to highlight about the energy class, clean energy as an asset class for the banking sector, and for obviously for the investor class, for the investor sectors.
Okay, thank you very much, Mr. Manpuran. Our second question is about the key parameters considered by the financial institutions before investing in a project. Can you tell us a little bit about that? Over to you.
Sure. Uh, you said key factors, right? Not the risk one. Key factors so the lenders will be looking at before financing. So obviously, the lenders would be looking uh, at the project viabilities first, whether the project is viable. First thing first, the project is viable. Whether the project is located in a very good location, the availability of land and different permitting process. The next thing about the project is about the supply contracts. Whether you have the EPC, I would say it has to be a fixed price EPC contract, fixed price time bound EPC contract with a reputed EPC contractor. And then sometimes there is a chance of cost overrun, because what has happened in the last 2 years is many of the projects suffered delays or cost overrun because of the uncertainty in the market, the supply chain constraints and so on has uh, make some of the projects unviable. So we have to build sufficient contingencies in the project cost to make over for any cost overruns. So this is about the project. On the optic side, as I mentioned earlier, that the optic has to be long term. So when a lender is financing a project for 20 years or 25 years, they should be relying on a PPA, power purchase agreement, signed with the government bodies or a private body for a long term tenure. It has to be long term, 25 years or 20 years, and the price mechanism has to be clearly defined. It cannot be like linked to some currencies or some other things. On the lending side, the lenders, what they look at while financing a project is they should have sufficient uh, equity participation, that when a lenders is participating to finance a project, they should be financing only 70% or let's say 75%. So whether equity participation is there to the extent of 30% or 25%, if that is there, then the project is safer for them. Then obviously this would be talking about the loan tenure. If a PPA is there for 25 years, they would be looking at a loan tenure of 22 years or 23 years to have a sufficient negative tail uh, for the PPAs.
Mr. Manpuran, can you turn on your video?
Yeah, this switch on, no?
Ah, now it's switched on. It
Oh,
went off.
yeah. Okay, sorry.
Yeah.
I'm sorry for that.
O-
Yeah.
Okay, no problem. Can you just wrap up in a minute about the key parameters? Yeah, go ahead.
Yeah, so this is what I was talking about, that the project, the lenders will be looking at a project from the feasibility perspective, then financial viability perspective. The project should have a uptake which is basically has eliminated the risk of the uptake. Uptake means the PPs, the long term contract has to be there, and then the project should have eliminated the currency risk. If you have a currency risk or interest rate risk, it has to be eliminated. It has to be hazed with certain uh, uh, solutions. So these are the parameters I would like to highlight while for the lenders before financing a project.
Thank you very much, Mr. Manpuran, and I'm sure we'll get back to you with more questions after we finish with our panelists. Denicia, can you hear me?
Yes, I can hear you just
You
fine.
can. Excellent. Wonderful. It's a pleasure to introduce Denicia. She is an associate with the 386 Development, a private equity fund part of the Al Khayat Investments. She is responsible for assisting with the process of financing solar and wind projects, building knowledge of market trends, local legislation, and lender appetite for relevant projects and locations. And she's a channel partner management and client due diligence. Denisha has more than 12 years of international experience in business development in various sectors, including military contracting, very dangerous, diesel power generation, and solar energy. Welcome to our panel, Denicia. It's a pleasure to have you with us.
Thank you, and
And
pleasure being here.
excellent. And we like to start off with asking you about what makes a project financeable, and what can the resource-rich nations of the region do to create a vibrant, clean electricity financing markets for renewables. Over to you, Delicia.
Yeah, I will try to bring up some new points because I think my colleagues have pretty much covered everything, especially because they're both working in finance. So today I would like to wear two hats: one as the Secretary General of Middle-East Renewable Association, and one as working with a private equity investor for 386. And I think it's really important that once you decide to, as a financial institution, decide to take on a solar project, I think it's very important to have a legal advisor in place that can advise you with the local regulations, make sure they can put a contract together to really cover all the PPA terms or the lease agreement terms, depending on the type of the contract, the exit terms, the default terms. So having a robust text really makes a difference because, things can go south really quickly. So that is where I think the KYC comes in, the know your client. So the client due diligence is extremely important. Learning about their credit worthiness, finding out if there's any collaterals, if they can provide any guarantees, whether that's corporate or bank guarantee, and really making sure that the off-takers are legit and they have a legit business operation. They are sustainable. They are estimated to be on the market for a long time. They won't just, pack and leave. They also need to make sure that they have a good credit rating. Ultimately, as a financier, you want to make sure you're covered. So you have to run them through, and Johnny will probably talk more about that. You have to make sure you're covered, and you assess all the risks that you're exposing yourself to as a financier. And also you want to make sure that the developer or the EPC that you're hiring is using the proper solutions and products. And I think we have tier one companies on this panel session today, and even figure out the engineering part and know how to really fully leverage on the available space. Do a site survey. Before I noticed one of the questions on the chat, if financing institutions would consider financing a project just from the satellite report or something. So no, you really need to go do a site survey, check the available space, check if it's an industrial area, what's the percentage of dust, how are you going to do the O&M, are you going to be able to deploy people there on a monthly basis or bi-monthly basis. So that is also really important to make sure there's no surprises, there's no artifacts in the land or whatever it is. Also, you want to check what what tariff the off-taker is paying at the moment. So in the case of Saudi Arabia, we know there's different tariff schemes at the moment between commercial and industrial. So you want to make sure the adding the solar system would make sense. So that this was me talking as a investor, private equity investor, but as a MESIA member, Middle East Solar Industry Association, our interest as an association is that all this information is available to all the stakeholders, and that it's filtered when it comes to the off-takers, because in reality, all the off-takers have really limited knowledge when it comes to all the terms that we use. We all sound really fancy on paper and in person, but you really, it's really a plus one type of deal. So all the off-takers want to know is that they're saving money and that they don't owe anything, to anyone. So it's all on the a risk taken by the investors. When it comes to financing, obviously, it's different. So there's other risks there. But yeah, I think creating awareness, it's important amongst the CNI sector and to encourage them to implement solar PV in their businesses.
Thank you, Denicia. This is very important. Yes, this awareness and capacity building is a continuous thing, and I'm sure that you're doing your part with the NGO, the Middle East Solar Association. The second question would be about the key parameters considered by the financial institutions before investing in the project. What do you think are these parameters? Over to you, Denicia.
Yeah, so I think Manuparan covered it, a lot of it. I would say that as I'm doing them personally for our company, the due diligence reports, they're very extremely important, not only on the client, but also on the premise itself, on the EPCs, on the whoever's providing the guarantee. So the KYC on the off-takers to do a robust credit worthiness analysis. And I think you have the right guy here to talk about it, Johnny. He was extremely experienced in the banking sector. You want to make sure the off-takers have their audited accounts, so there's opacity there. And you want to make sure there's available information from the credit agencies. I won't name any names, but some credit agencies have limited information when it comes to companies. They maybe only have visibility locally on the company, but not like at a regional level, let alone international. So yeah, in line with what Manu Paran said, you also have to consider the stability of the country and the risk of the currency, the regulations not fluctuating, not being capped every couple of years. And yeah, also regulations that favor the off-takers and the permitting process is smooth. So yeah, there's a lot of factors involved.
Yes, definitely. But they also the oil-rich countries. They have a lot of money and they have a lot of cash, and so it makes their let's say life easier in getting the credit, and the financial institution should be happy giving them money to do solar. My third question would be about the challenges that are faced by developers in arranging financing for the projects. Can you tell us a little bit about that? Over to you.
Yeah, so I've been working in for a private equity investment firm, for the last year. So maybe I'm just scratching the surface. I think there's people more with more knowledge on this, but I know there's equity available from private companies. The corporate loans are available, but only for utility scale companies, from financiers, from banks. And the non-recourse debt is limited. And at the moment, banks don't really have the product. I mean, they can provide corporate loans, but not without recourse for the CNI space. Utility scale is a different topic, but I know there's different schemes in the US and in India. I see there's a big audience here from India, which are obviously bigger markets and more developed. I have been launching schemes for the CNI projects for years. I know that in the UAE, they've launched a sustainable finance framework for the next decade. I think it started in 2021 till 2031, called the Dubai Declaration of Financial Institutions in the UAE. So they're encouraging the sustainable finance and the facilitation of green finance in line with the sustainability goals for both the UAE Vision 2050 and then Saudi Arabia for Vision 2030. But yeah, there's not a lot of banks and investment companies that make investments at this level of CNI. The financing institutions need the critical mass, and in the current market, it's unachievable because of the legislation that's capped. So again, it's fine for utility scale projects or maybe residential, because you can get construction loans, but for the CNI projects, they're not big enough to warrant the large investments from the banks. So obviously, the financing depends on the owner of the project and if it's capex, and when the off-taker decides to finance it themselves. But you really have to look at the credit worthiness of the company that's paying the electricity. So hopefully, it will encourage more investors to meet the corporate sustainability goals. Again, makes sense if the projects are bundled in a portfolio that focuses on large-scale megawatts. So I think there's positive movement in that sense. I know I read about Total Energies that partnered with the National Bank of Fujairah and Apicorp to finance about 50 megawatts, I want to say. So, and there's Total also did a joint venture for CNI in the KSA. So again, there's movement in that space, but yeah, you really have to assess the bankability of the solar projects.
Thank you very much, Denicia, and I'm sure that we will come back to you with more questions after we finish asking our esteemed panelists. Johnny, can you hear us?
Yes, I can hear you right.
Excellent. Mr. Johnny is working for a consultancy, Vari Consultancy. He's the founder and managing director. His background is in risk management, and after working in corporate and investment banking credit risk for almost 13 years, he established a consulting boutique in 2020. Congratulations. Been working on establishing and improving due diligence, credit risk management, general risk management, and investment committee underwriting practices of solar energy investments in companies. Welcome to our panel, and it's a pleasure to have you with us. And we are eager to hear from you about your experiences in identifying the risks and de-risking, so we can establish more solar projects. The first question would be is how to focus on on improving the risk or de-risking the solar projects. Can you tell us a little bit about that? Over to you.
Sure, thank you for that, Summer. So I think I wanted to just first start by just describing how the renewable energy sector may be slightly different from other sectors when it comes to risk management. And some of the points have been mentioned. So, for example, one of the key characteristics is that we're talking about very long-term projects, often 10 years plus, up to 20, 25 years even. So that means that there's often an embedded credit risk for a very long time, and obviously it makes it more difficult to predict the risk if you're locked into long-term contracts. Secondly, one thing that I've experienced, coming from a banking background and then moving into the renewable energy sector in terms of where my clients are, the sector is unregulated in the sense that we're not talking about regulated banks here, yet many of them have a financing element built into their business model. And that also means that there's less clear sort of guidance on how do you assess your projects, what are the criteria for evaluating a specific investment object, how do you assess your off-takers, what's an acceptable level of credit risk, what's unacceptable. So that would be like sort of the second point that I would point out as a characteristic of the sector. Thirdly, because of the sort of unregulated financing element, my experience is that it's not as clear what all the different terms mean. So we've had some of my fellow panelists have been discussing certain things being low risk and high risk, but the question is, what is low risk, what is high risk? That will depend on the investor and the investor's risk appetite, right? Lastly, many of these firms put on different hats, or the people working in the firms put on different hats for the same project. So you don't necessarily have a specialized credit risk analyst sitting in-house. You don't have a specialized operational risk analyst sitting in-house. You may have limited in-house legal counsel, and that in itself also raises some challenges. So that's the sort of backdrop to the sector. If we're then talking about limiting risks or de-risking, as you mentioned, I think the first step is really to create a risk framework. So you first need to have the risk management framework where you have sort of identified these terms. What do we mean by low risk, high risk? And then we can reduce it.
Sounds good. So follow up on this advice. What can the companies do in house versus involving external advisors and consultants? What is your advice on that? Over to you.
So I think Denisa mentioned some of the challenges specific to the region, which is limited access to data. Many of the companies are not publicly rated, particularly if they're smaller corporates and privately owned. That means that you need to have some kind of credit risk expertise in order to really assess the off-takers' risk that you're taking. There are various models for doing that. You can either hire someone internally to do the work and setting up your own internal models. What I see is that many don't have the scale for that. So it might not be commercially viable to set up a full-blown credit risk department and have your own internal models and so on and so forth. And that's where you can bring in external expertise until you reach the point where you have the scale to hire someone internally. Then when it comes to other forms of risks, I've talked about credit risk, but if we look at the operational risk, I find that the experience is greater there because many of the people working in the industry, they have the technical background, they have the technical expertise. They fully understand how the product is built and what can go wrong with it. So I don't see as many gaps there. That's probably something that is best done in-house anyway, because you're closer to the project as opposed to bringing someone in. And it might be more of a question of formalizing that internally. To sort of bring it back to the overall topic of raising finance, you may be doing everything right and you may know exactly what your operational risks are, whether you are happy with the credit risk and so on. Then you approach an equity investor or a debt investor, a fund or a bank, and you say that, this is what we do, but they want to see sort of the proof. So it might be a case of you doing everything right, but you need to also have it, in a format that, let's say, a conservative risk analyst at a bank likes it, which is in alphabetical order, in a nice DD room, all the policies, procedures, everything is there, showing how you comply with it. That's where it's often lacking. So one way to de-risk it is actually, to come back to your question, one way to de-risk a product at times is simply to know what the risks are. Because when you're seeking finance, credit risk manager being one myself previously, if we don't know, we will assume the worst. Yeah. So it's often better to know what your risks are in the project and clearly flag those and outline them, and then say how you're looking to address them, than to just sort of forget about them or even worse, not mention them and hide it actively. That's when warning flags are sort of shown within the bank. So.
Thank you very much, Johnny.
If I just may, as an example, so I just put up a quick poll in the room on whether the audience thinks that the credit risk in the solar power sector, or the credit risk they're taking on off-takers, will it reduce, stay unchanged, or increase over the next year? And if we look at the results so far, some 14 votes, So I'm expecting another 60 or so of you to vote. But based on the votes we have now, we have half of the people say reduce and sort of 1/3 say increase. So the point being that, whatever the right answer is, people have different views of it. So you might have one view in your company, and the financier might have a completely different view. So when you're talking about de-risking, how do you define risk in your company? What do you define as a high risk or low risk? And have that transparency. You can put up a risk matrix, for example. I think it just shows that people have different views, and you need to be very transparent of what you mean exactly.
Yeah, definitely. Yeah, statistics play a big role in this. Uh, I want you to tell us about, from your experience, what happened during COVID-19. If you were managing any projects, and because of the lockdowns, energy consumption went down, and so how did that lockdown impacted the solar projects, and how is it now included in your risk matrix and future risk matrix? Over to you.
Yeah, actually, when COVID hit, I was part of setting up a new digital bank, so it was not in solar sector. But I can tell you broadly what was interesting with the pandemic hitting was that working in risk management, it's not like anyone could potentially say that it was going to happen, a pandemic exactly in that year, right? But working for banks previously, we've been modeling pandemics, we've been modeling IT security threats, natural disasters, and all of these very, very unlikely events, and having plans in place. And you know what it's like, most people are sort of, oh, do we need to do this exercise again? Whereas in risk management, it's part of the general day-to-day work. So when this actually occurred, I feel like there's a greater respect for risk management generally. There's a greater level of awareness in all sectors, not only solar, but solar being one of them. And I saw an increase in demand for people wanting to understand what are the risks we're taking in our business, really, and how can we manage them more effectively, and actually how can we use them as a competitive advantage. And for me, it was actually the tipping point to set up the consultancy, to leave the banking world, set up the consultancy, and work with corporates on this topic. So I think that's the main impact I've seen across several industries: greater level of awareness, and also more energy to actually understand these topics, and a greater interest in them.
Okay, very good. My last question to you is really about what's happening. As the solar PV market matures, you have more renewable energy, clean energy on the grid, and so the saturation level might increase. So maybe the grid operator, I will ask to shut down the solar PV project when there is no demand, for example, on a weekend or during, let's say, spring. Did you experience such, let's say, events, and how are you going? Are you modeling it in your future projects?
I've not experienced that particular scenario that you mentioned. What I would say is like this: if you think about it, I had this discussion the other day. If you think about it, you mentioned one potential scenario that could occur, right? Which would have a
Yes.
negative impact on a particular business. Now, what other scenarios could you come up with? We could probably stay here all day. It's just about up to imagination, right? There are other generic business risks, not specific to the solar sector, regarding IT security. There's a new personal data law in the UAE that just came in. How many are compliant with that within the solar energy sector, for example? There are data privacy laws, cybersecurity, and then on top of that, you have industry specific scenarios that you mentioned. You have regulations, uncertain regulations, so on. The point is that most of these events, there's a very small likelihood that they will occur, let's say in the next year, right? Might be 0.0001, yeah? But if you add up all the number of events that could happen, each of them very, very small, how many events could you come up with? You could come up probably with an unlimited number, which means that the likelihood of the scenario you just mentioned happening is probably quite small. But the likelihood that any one of those events will happen is very large because there are so many of them, right? And it's very difficult as a risk manager or as a business leader to know which one is it that's going to happen, that's going to affect my business negatively. It's very difficult to predict that. So the point is, if you have a systematic framework for identifying risks that arise, I think that's the answer to most of the issues that we've talked about, most of the risks that we've talked about. It's about having the framework in place, being vigilant, and if you can, even use them to your benefit. So perhaps the scenario you mentioned, maybe you have a specific pricing model that nobody else has that takes this into consideration. So if this risk occur, actually you're going to come out on top of it, because risks are not only they're not only negative, there can be positive outcomes as well.
I hope so. Okay. Thank you very much, Johnny. And
Thank you.
we go over to Simon. Simon, are you with us? Can you hear me?
Yeah, I can hear you.
Excellent.
Summer.
Simon, first of all, thank you very much for the presentation. Simon has a background in power system studies, grid reliability, energy market and construction, and he can tell us a lot about the development of solar PV projects on high voltage DC. So, can you tell us a little bit more from your experience about with the increased percentage of renewable energy, solar, especially solar and wind, on the national grid? In your case, you're talking about transmission. So, how is the grid operator? What or you? I think you were talking about China and Chile, maybe. So, what is the percentage of renewable energy in your mix, and where are you going, and how are you dealing with that? Over to you.
Yeah, thank you. Yeah, we've seen a lot of renewables entering the market last 10 years. It's a case of exploration of study. It's a lot of renewable energy for a system that wasn't prepared at all. So we started to see a lot of bottlenecks everywhere around. The case you just mentioned, that you could lose energy because you have lack of demand, for example. It doesn't happen quite that, but if you have in transmissions bottleneck, you are going to lose energy. And it's so predictable. It happens all the time, every day, between at the solar hours and daylight. So between 2 p.m. and 5 p.m., we have these bottlenecks, and marginal costs drop to zero everywhere around. I don't want to keep showing you graphs, but I have the usual graphic that in the same day we have zero marginal costs in those hours, and we have $400 in the night. So the differences in prices during day, every day, it's very predictable. It also it's also happening in Europe. Yesterday, I saw the news that they had 70 euros per megawatt hours. I think I saw. So these differences are are becoming a thing because of, well, renewables. We started to leave some usual conventional technologies behind, for example, the nuclear energy in Germany, and the ambition of transit the system into a renewable system, it's too big right now, and yeah, it's a good exercise to think it through, to stay calm and not go up ahead yet, because the system, I don't think is ready yet. All the authorities right now are committing to goals where they are decarbonized to 2030. And from my expertise point of view, I don't think it's possible. But if we want to reach some kind of that level, we should take these few things into consideration. And of course, if you can de-risk your investment by placing storage system, it's a great way to do it. We encourage people to buy storage system, not only because we're selling it, but also because it helps to save energy for nighttime. And besides, in the countries where energy arbitrage is allowed, uh, these differences in prices is the best scenario you can get. You can buy energy at zero, and you can sell it at $400 per megawatt. So, yeah, you need a good model. There's also, I know it's a very delicate thing to forecast these projects to 20, 30 years. And nobody knows actually if this difference between energy prices is going to maintain in the long term. So yeah, there are a lot of things that you need to consider at the end of it.
Yes. Um, because of your experience in the grid, I'd like to ask you another question regarding developing solar PV projects and developing the infrastructure at the same time. Have you done such a project in the past where you are developing the project, the power plant, but you're also developing the grid itself, the infrastructure itself? Over to you.
Yeah, well, usually if you wanna get the banking, you need to be aware of your surroundings. You can't build some infrastructure that can't connect to the grid because some other facilities are not ready for it. That happens all the time with the transmission capacity. If you have a particular substation that you think, I don't know, I own this land, I can place all these solar panels, but if the substation doesn't have the capacity to put one additional bay in it, there's no space. So yeah, you need to explore that. Most of the time where the transmission system is separated from the generation system, you need to ask for permissions, and if not only to know if there's space available to connect to it, but if there's the technical capacity. And also, what about the energy, the amount of power you try to transmit? Because you can be right in the middle of the dense populated area, or you can be like way out of it. So if you have to travel long distances, you're gonna need the studies to know if you're gonna be able to transmit that kind of power because of technical limitations. A lot of times you have these power plants that connect to the grid with a utility scale level, and for example 200 megawatts, and because of the distances from the consumers, you have to limit to 10 100 megawatts. So this is like the worst case. And even in worst cases, we've seen that the the short circuit ratio is so low that the power plant, the full power plant, couldn't connect at all, and finally the project went bankrupt. So these are situations that can happen every day if you don't do a good assessment of the situation of your surroundings, and finally the risk.
Thank you, Simon. Um, I have a question regarding the infrastructure and the cost of development. As you said, when you have a solar PV project, it gives you energy during the day, and you transmit the energy during the day, so 100 kilometers or 1,000 kilometers, whatever. But during the night, the lines are empty. So any recommendations for the TSO?
Yeah, thank you. In the case in the Chilean case, the transmission is a monopoly regulated, so the transmission infrastructure are decreed from the authorities, and they assure the owners a certain amount of profitability. So in the case the countries thinking of decarbonize, they should, well, it's a thing under discussion right now, but they should decree the storage system belonging to the transmission. This is my point of view, of course, but the storage system should give enough room for energy during daylight. To save energy during daylight to deliver at night. And this is in my perspective, this is a transmission requirement, because you can build all the power plants, all the solar power plants you can, but they won't work at night unless you build a concentration solar power plant. But those are very expensive, and you can take 7 years or more to build them. And so the photovoltaics are like a year long. So most probably we're going to use several storage facilities from this. Right now it's lithium based mostly, but I hope in the future hydrogen is a good expectation, and I hope that that's the way to do it.
Thank you very much, Simon. I'm sure that we will get back to you with the questions once we hear the questions from the audience from Meenakshi. Over to you. Meenakshi, do you have questions to us?
Yes, we have a couple of questions that can be addressed. I'll just present the questions on the screen.
Yes, please. Will it acceptable to banks to finance a project with solar resource data from satellite only without conducting any site measurement? I don't think so. It's not possible. But Johnny, like to or Denisha answer that?
I think Denisa answered it. It's probably
Yeah,
quite
it's very important to do a site visit to check the available connection points, to check where you would be installing all the equipment, to check the quality of the soil. Yeah, and
If I may add one point, though, I remember the first
Yeah.
product finance that I did within banking, where the client actually being the company being financed, they actually set up a camera to monitor progress, and they gave us a link to an online video where basically you could go in as a credit manager and see, yes, there is activity, yes, they are actually building. I found that quite interesting because it also gave sort of a relationship to the projects being in a different country. So that might be one tip, that maybe use it for monitoring and share it with the investors.
Yeah, that's as far as the condition, but we're talking about resource data, and you need
Yeah.
at least 2-3 years of data. So it's satellite data always they have like a margin of error around
That's right.
20 to 15%. Yeah.
So I mean, just to
Yeah.
sorry, this is Ali. I mean, from Standard Chartered. I mean, if I were to ask, I think that the question was less about the on-site activity. I think it's more about the resource risk and the data that we have generally. I mean, you're absolutely right, Samir, that banks do prefer on-site, on-ground data collected over the satellite data. Having said that, look, I mean, we're working with very, very fine coverage ratios, right? So from a banking perspective, the less data you have, it doesn't make it completely unfinanceable. It's just that the margin of error, as you increase the margin of error, the higher coverage ratios which you require. For example, if you're working with a P90 1.20, 1.25 with purely satellite data, you can you can definitely finance it with a higher coverage ratio, like 1.40, 1.45. So there are ways of financing it. But as you have less data, you'll probably need to have built in margin for error, and you'll basically have to increase the coverage ratios, cash flow coverage ratios for the banks.
Ahmed, I hope we answered your question, but it depends also on the size of the project that you want to get financed. So if you're talking about 1 megawatt, 5 megawatt, maybe up to 10 megawatt, the bank maybe would not ask for resource data. But if you're talking about 50, 100, or 200 or 1,000 megawatts, they definitely will ask for a resource data. Meenakshi, you have another question for us?
Yes, I'll
Yes,
present
please.
our next question on the screen.
Yes. How you see the future of renewable energy market in MENA region? Is the storage or hybrid renewable energy project will have any availability issue as far financing is concerned? Let's move to all our panelists and try to give opportunity for all of them to answer this question. We start with Mr. Ali. Mr. Ali, how do you see the future of renewable energy market in MENA? Over to you.
I think no, thanks. I mean, look, as I stated right in the beginning, I think the future of the renewable energy market is great. I mean, everything I think works quite well. Everything that is required to be there for the successful renewable program is here. There is quite a willingness at the government side, because the renewable sort of capacity is the core of every government's strategy. So there is a lot of regulatory support. Capital is available to the highly rated countries, and then in the form of commercial debt in sub-investment grade countries like Egypt and Oman and Bahrain. There are other forms of debt available. There is DFI support, as well as export credit agencies who are willing to support. So capital is there, definitely there. Resource, as you know, is sunlight is plentiful in the region, and land is available. So everything is clicking together, and I see a very bright future of renewable energy. The programs are big, and they're delivering on these programs. So definitely a lot of stuff to come. As far as the
Thank you.
storage is concerned, the second part of the question, very quickly on the storage. Look, storage completely depends on viability, right? I mean, the region, you have hydrocarbons as well, right? So effectively, as of today, primarily the renewable energy is daytime energy, except for one CSP project in Dubai, which is being set up at a good tariff, but it's definitely more expensive than just the daytime energy of PV. So I think it just completely depends on the viability in terms of costs and opportunity costs of the storage solutions that are available. I mean, where we're also looking at hydrogen in the region,
Thank you,
which has
Ali.
been mentioned. Yep, yep.
Thank you, Ali, because we don't have time and we need to give the other panelists the opportunity. Mr. Mr. Manpuran, are you with us? Can you hear me?
Yeah, yes, Mr. Samar, I'm there. Yeah, tell me.
Okay, in 1 minute, you have 1 minute to answer this question regarding the future of renewable energy in MENA.
Yeah, as Mr. Ali said, the future is really good,
Over to you.
really bright. For the future is really bright for MENA regions in terms of renewable energy. We have still a gap between the peak capacity. I mean, peak capacity from the solar or and wind combined versus the peak demand. So still have a long way to achieve to maximize our solar and wind capacity to reach the maximum demand. Now, coming back to the battery system, and until that point, you do not need a battery uh, for this particular region. But yes, after you crossing that peak capacity or peak demand during the day, you need to have battery if you want to supply more, if you want to install more amount of solar capacities into this region. But now, yes, you have sufficient room for that. You have additional, I do not know how much capacity you can add additional, but I believe we have still rooms to add another 20% capacity on the solar and wind combined.
Thank you very much. Denicia, it's your turn now. What do you,
Sorry.
go ahead.
Yeah, from experience, I've seen both in this region that there's still businesses that run on diesel generators, and including in the UAE, so where DUS substances are not available, or IWA, whatever it is, whichever authority. So I believe hybrid solutions will still run for a while. At least in the remote areas, you can still use conventional and renewable energy solutions. As my colleague said, I don't think batteries are viable at the moment, unless you're referring to neon, and it's a different story.
Thank you. Thank you, Denicia, very much. Johnny, over to you. How do you see the renewable energy market in MENA?
I mean, I see it developing, I should say, as in there's growth, but there's also development to be done in terms of the types of financing being done. So, for example, I think there's a great opportunity for, let's say, more innovative or structured financing arrangements. So, for example, combining export credit guarantees from Western jurisdictions exporting into the region, thereby having sort of a secured senior tier debt provided by banks, and then you could have a non-bank institution coming in at a higher rate but at a higher risk. These kind of arrangements, you're not really seeing them for the smaller projects, but I think there's scope to do it. So I would encourage companies to sort of look a little bit broader, and then I think the next wave in a couple of years' time, hopefully, will be when you see energy companies starting issuing, let's say, renewable-linked debt instrument like bonds. We've seen high growth over the last 1 or 2 years, but that's primarily been driven by banks issuing social bonds and environment-linked bonds. We haven't really seen it in the energy sector yet.
Thank
So
you.
that means there's a lot of opportunity for that.
Thank you very much, Johnny. Over to you, Simon. You are our last speaker for the day and first speaker of the day. In 1 minute, can you sum up your, let's say, expectations for the renewable energy in MENA?
Yeah, thank you. Well, I think that relatively speaking, if you have a cheaper solution, batteries have a hard time to get into the market. You need, I mean, if they're needed somewhere, they're going to be built, definitely. But if you have some other storage, other ways of store energy, such as fossil fuels, for example, it's hard to believe that batteries have like a close future. but yeah, I think at some point everyone's gonna need it.
Thank you. Thank you very much, Simon. With this, we end our session for today. Big thanks to Solar Quarter. Big thanks to Huawei for sponsoring, and huge thanks to Meenakshi for her support and bringing us to this webinar. And big thanks to our esteemed panelists for sharing their experiences. Over to you, Meenakshi.
Thank you so much to our esteemed panel for this wonderful session, and very special thanks to Sameer sir for superbly managing this session. It was a pleasure having you in such a well-planned and high-energy panel discussion. Thank you everyone for extending your time and support for the event. We promise to come back with more exciting topics very soon. Special thanks to our partner for this webinar, Huawei. Thank you everyone.
Thank you.
Thank you. Have a good day.